Fidelity bonds and fiduciary liability insurance are often confused, but there is a big difference. So a fidelity bond is a contract between an insurance company and a fund that's going to cover employee theft and employee dishonesty, intentional acts. Fidelity bonds are the only thing that are required by ERISA. By contrast, fiduciary liability insurance is designed for negligence when trustees of benefit plans are accused of a mistake, negligence. The classic case is breach of fiduciary duty and also negligent errors and omissions in the administration of a plan. And fiduciary liability is not required by ERISA. You need to get a qualified broker in order to determine how much coverage you need. It's a matter of the limits of liability and the price. Typically, the first thing you would ask in determining how much coverage you need is what's the size of your plan. If you have a large plan, you need more insurance. Obviously, if you're a smaller plan, you need less insurance. We have benchmarking, and we typically think plans with $10 million or less in assets can go as little as $500,000 or $1 million of limits. If you're between $10 million and $50 million, you probably need to consider $1 million to $5 million. And if you're somewhere between $100 million and $500 million, you would start considering $10 million in limits. And for large funds over $500 million, you would consider $10 million in limits and up to $25 million. And some get towers of insurance as much as $50 million. But you're starting with what your assets are that you're protecting in the fund. There has been a lot of creativity and innovation in fiduciary liability insurance in the last several years. The first thing and the most dramatic change is coverage for voluntary compliance programs. That's where the Department of Labor and the IRS are encouraging trustees to fix mistakes in the plan themselves, to correct problems in these voluntary compliance programs. The problem for trustees is a lot of times you can't pay out of plan assets. Therefore, fiduciary liability insurance carriers have responded and have been providing coverage for mistakes that you make and correct yourself, voluntary compliance programs. The second thing we're seeing is coverage for DOL audits that don't initially trigger the policies. And so insurance companies have started providing pre-claim investigation costs. When you have a DOL audit that takes a long time, requires an attorney to help you in an interview or document request. The third area of innovation that we're seeing is coverage for penalties. Typically, an insurance policy is not going to cover penalties unless it's carved back or applied. With the Pension Protection Act, we saw a lot of reporting requirements under 502C. We're seeing more and more penalties from the IRS, excise taxes under 4975, and we're seeing all sorts of other penalties under the ACA and healthcare reform. And a lot of the cutting-edge insurance companies are responding by providing affirmative penalty coverage.
Most important thing is that your duty is to the participants and beneficiaries, not to anyone else.
Who's running it, who's using it, and who's paying for it.
Fiduciary standards have some gray areas.
Have more contributions, more dollars coming in.